Welcome back to EG Financials. Today we're taking a look at the new Freddie Mac Outlook report, looking at the real estate market for 2024 and 2025, and they include their price predictions. Starting off with key observations, U.S. economic growth remains on firm ground, with strong consumption spending and a tight labor market. Although housing market activity has slowed, a demand-supply imbalance in the U.S. is causing a rebound in home prices. Second quarter real GDP growing at an annualized rate of 2.4%, stronger than in the first quarter, which was 2%. Consumer spending grew at 1.6% annualized rate in the second quarter, and consumers remain generally upbeat, likely reflecting the deceleration in inflation, tight labor market, and the cushion they have from the excess savings accumulated during the pandemic. The unemployment rate ticked down to 3.5% to remain close to the 50-year lows. Wage growth remains solid, with average hourly earnings increasing 4.4% over the past year. And in this chart, we're looking at the existing mortgages and what their current rates are. This chart is showing us that about 2/3 of mortgages have a mortgage rate below 4%. About 23% of current mortgages have an interest rate below 3%. About 38% of mortgages have an interest rate between 3 and 4%. 20% of mortgages are between 4 and 5%. And only 9% of mortgages have a mortgage rate higher than 6%. Home sales have slowed due to the 30-year fixed rate mortgage rate staying above 6.5% since May 2023, and yet the market remains undersupplied given the current demand, partially due to the mortgage rate lock-in effect. And again, this is where homeowners have that low rate locked in, whether it's 2.75 or 3%, they're not going to give that mortgage up to go get a 7% mortgage. The inventory of existing homes for sale remained unchanged in June at 1.08 million units, down 13.6% from a year ago. And now we'll take a look at Freddie Mac's predictions for house prices in the next 2 years. Freddie Mac's forecast for the next 12 months has house prices rising by 0.8% and an additional 0.9% over the following 12 months. Consistent with our projection of a gradually softening labor market, they're expecting unemployment rate to increase. This is more optimistic than earlier in the year, mainly due to the rebound in prices after the house price declines in the second half of 2022. We believe the rebound in prices is driven by a combination of a very tight supply and the large cohort of millennial first-time homebuyers reaching prime home buying age. It is evident that despite affordability issues, there is tremendous demographic-driven demand for houses relative to supply, which will continue to keep upward pressure on prices. We expect the labor market to gradually soften without major adverse effect on the economy. And that's it for this quick summary of this Outlook report. Later this week and early next week, we will be covering additional institutional forecasts, so make sure you follow for more updates.